Understanding this fundamental relationship in the markets will allow you to become a consistent trader while avoiding the common pitfalls that plague a lot of new traders. In trading, there is something that I call the golden rule. This is the foundation of all market relationships and assumptions. And this relationship is the relationship between the possible loss, the possible profit, and the probability that you'll make money on any given trade. Why is this relationship so important? Well, understanding this will allow you to not only become a consistent trader, but avoid a lot of the common pitfalls that evolve with a lot of new traders. So first, what is this relationship? Basically, as the amount of money that you risk increases in a trade relative to the amount of money you can make, the probability that you will make money on that trade will also increase. For example, let's say that you take a trade, and on this trade you could possibly lose $500, or you could make $500. Now, this relationship stipulates that the probability that you'll make money on this trade is just around 50%. Why is that? This is because the prices in the market are intentionally designed to be fair and efficient. More on this in a future video, but for now, we must understand that the relationship between the amount of money you could stand to lose and the amount of money you can stand to make is directly correlated with the probability that you will be profitable on any given trade. Here's another example. Let's say you want to swing for the fences and you want to put up $1,000 to potentially make $10,000. It sounds nice in theory, but the probability that you'll actually end up making that $10,000 as opposed to losing the $1,000 is just around 9%. Why is that? Well, it's because the profit target that you have in this trade is 10 times the amount that you're willing to lose. In fact, the way we can look at this relationship mathematically is described by this following formula. The probability of you making money on a trade is roughly equal to the amount of money that is at risk divided by the total amount of money at risk plus the amount of money that you could make. I say roughly because there are always exceptions to this, but this is a very good way to understand the fundamental relationship between risk and return. So how does this help you as a trader? Well, if you have a trading strategy that you're trying to implement or improve, it's important to remember that the amount that you're willing to make on that trade and the amount that you're willing to lose in that trade will directly affect the probability and consistency at which you make money. Understanding this will allow you to tweak those profit and loss targets to better hone in on a probability of profit that works good for your trading style. The probability of profit on any given trade is the key driver of consistency in any trader's account. If the probability of making money on your trades is too low, what you'll find is that your account will be generally in a decline with the occasional big winner. And for that kind of performance, you're better off taking your money to Vegas, where at least you can get your room and dinner covered. The other side to this is having too high of a probability of making money. Now, this sounds kind of nice in theory, and a lot of people will say, well, what's the problem with that? Well, the reality is a probability of making money that's too high will result in you making a little bit of money on a lot of trades with the one occasional loss that could wipe out months or even years of profits. Most people can't handle sudden shocks to their portfolio to that magnitude, so it's generally better to stay away from strategies that have a very high win rate but could lead to a disastrous loss. I have found that probability of profits ranging between 60 and 70% are the ideal spot to start for most traders. This is because you set yourself up to win roughly 2 out of every 3 trades, and the times that you lose are relatively manageable and easy to recover. Another benefit of understanding this relationship is that you will have a better understanding of setting proper expectations when heading into a trade. If you hear of a trade that somebody's doing that seems to always make money with very little loss potential and a high win rate, you'll start to understand that either that person is a scammer or they're getting very lucky. Either way, it's not a trade that's really worth your time because there's no consistency involved in the long run. The reason it's unsustainable is because a trade that carries a high win rate, a high profit potential, and a low loss potential does not follow the relationship between risk and reward, which means there's usually something else that's going on below the surface. Hopefully this helps you get a little bit more understanding of some fundamental trading concepts. If you enjoyed this video, please give us a like, subscribe, and hit that notification bell so you always get notified of new content from us. I've been Anton Kulikov. Thanks so much for watching, and I'll see you in the next one. Bye-bye.